I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and today I'm delighted to welcome Lorenzo Bini Smaghi, chair of the Board of Société Générale and former policymaker, including at the ECB. Welcome, Lorenzo.
Thank you very much.
And I would like to discuss with him some issues related to banking union, of which we're just kind of celebrating the 10th anniversary, as well as the capital market union, which hasn't made as much progress as we would like to have seen. Let me start with kind of looking back a little bit, actually exactly 1 year. There is the saying that the proof of the pudding is in the eating, and the proof of a regulatory supervisory framework is in the crisis. So 2023 saw some fragility in banks in the US, in Switzerland, and some observers point to the fact that banks in the EU, including in the euro area, have not been affected by this turmoil and this fragility as a success for SSM, for the banking union in a broader sense. Do you agree with that?
You may say that we saw a crisis in the US, in Switzerland, not really in Europe, in the sense that there was some side effects from the crisis, but the European banking system was resilient. Now, I would not say that the purpose of a good banking system is never to have crises, because crises do happen actually, because the risk is to create a system which doesn't perform its functions, which is to allocate savings to investment and so to take risk. I mean, we should never forget that the role of banks, the very important role for banks, is to allocate savings to good investments and so to assess the riskiness of investment and take some risks. So I think the purpose of good supervision and good regulation is to make sure that banks assess well the risk, manage well the risk, and are able to absorb shocks in case of crisis. And I think the experience of the last 10 years shows that, to be sure, a single supervisory system, a single regulatory system is better capable of absorbing shocks than the 20 or more that we had before.
Now, this is the positive news, I would say. On the other hand, there seems to be somewhat a disconnect between very strong capital buffers, increasing earnings, which might also have helped in 2023 on the one hand, but on the other hand, the continuously low price-to-book values of European banks, including compared to the banks in the US. What explains this disconnect?
Now, I think this is a very good point. We have a disconnection between what supervisors look at, which is capital ratios, liquidity ratios, and so on and so forth, and what the markets, I would say, look at to assess the solidity of a system. And I think, as you mentioned, the striking issue is that we had profitability of banks moving up, capital buffers strengthening, and the valuations which have improved only slightly. What's the difference? What's the key factor? Well, first, I think we should discuss this issue, which has not been discussed enough. If you look at the key aspect is the relationship between the return on equity and the cost of equity. Now, it's true that the return on equity has been strengthening, but if you look at other sectors in the industry, look at pharmaceutical, utilities, I mean, they have improved also, and they have improved even more, you could say. So we should never forget that shareholders of banks are not obliged to hold shares of banks. They have a full choice. And so if they have better returns somewhere else, of course, they will try to invest in these other sectors. So return on equity is important. It's also, what is important is the prospects of this return on equity. So how this better performance that we experienced over the last couple of years, is it lasting? And that's obviously a key question. And what are the dangers, I would say? And one of the dangers that we have in Europe, for instance, that we don't have in the US, is, for instance, taxation. I mean, politicians love to tax banks, and we have seen that all over Europe. So an investor thinks, maybe this is good, but we have seen already taxes increasing, and so what about the future? So this is just to cite an example. But the other element of the equation is the cost of equity. I mean, what is striking? Now, the cost of equity is a complex measure. It's not easy to assess, to measure, but what most measures would tell you is that the cost of equity in the US of bank equity has come down back to the pre-crisis. The cost of equity in Europe has not come down, and it's actually increased over the last 5 or 6 years, in spite of all the regulation. Now, this is, I think, the puzzle, because having a single regulator, having a better system of supervision, the scope of all this was to reduce the cost of capital for investors. And this has not happened. So I think we should think about what are the reasons for that. And the regulators should also think about that. And some of the measures that have been taken in the past, I think have not been able to reduce the cost of capital. I think the biggest factor is the uncertainty about regulation. I think in the US, we are discussing about the end game of Basel, so it means that there is an end. Yeah. And in Europe, there doesn't seem to be an end. So if you are an investor, you tend to be afraid of investing in banks because you never see the end of the regulatory cycle. Yeah. I think this is something that I think supervisors and regulators often say that they think about it, but in practice, in reality, this is not happening, and there are huge uncertainties about the future.
Okay, so it's the policy environment, especially the lack of certainty going forward. So kind of changing gears a little bit, I mean, some observers, including you, kind of made the case also that the capital markets union, which has progressed much less than the banking union, might actually be critical to also complement the banking union. On the other hand, there seems to be also some kind of interaction that the success of one will also determine the success of the other. Can you elaborate a little bit on this?
Well, I think so. The two, in the end, go together from many points of view. First, you cannot have a capital market union unless you have the key element of the capital market, which is liquidity, moving around freely and efficiently. And this means a banking union, a very efficient banking union. Also, in order for the capital market union to happen, you need players, you need European players. And what we are observing on the banking side is that banks are actually shrinking in size, becoming more national. So the fragmentation in the banking system is not going to help the creation of a capital market.
So we need large pan-European players.
You need some pan-European players, and you need pan-European players which are active in the capital market. So you don't need only retail banks, you need banks that are, and when you observe what has happened over the last 10 years, in fact, there are less and less European players, and we cannot think that we can create the European capital market only with American banks, just to be very explicit. You need some European players. On all the segments, by the way, of the capital market, because we should not forget that certain players, think about rating agencies, about accountant, about analysts. I mean, these are largely these segments are largely based on non-European players. So we have to have European players in these segments. Now, how does the capital market help the banking union? Because that's the other element. Now, in order to have European players and for European banks to grow, you need to be what we can call capital light, in the sense that if you just add on banking activities, your balance sheet gets bigger and bigger, and there is a limit to that. So you need to be able to originate and distribute, if you want, in a good way, your balance sheet. So to lend to companies, lend to households, mortgages, and then repackage and resell to the market. And in order to do that, you need an efficient capital market that is able to do that. So capital markets and banks work together. And if they work together efficiently, that is very useful for both for savers, but also for investors.
Thank you. So I'm actually going to follow up with this now with two questions. One first on the banking union, then on the capital market union. On the banking union, I mean, we have an SSM, Single Supervisory Mechanisms, which will celebrate its 10th anniversary later this year. We have an SRM, a little bit younger, but also in place, maybe subject to some doubts. No EDIS, no deposit insurance. For the next 10 years of the banking union, what would you expect in terms of further development? What would you hope for?
Well, what have we learned, I think, over the last 10 years? That we didn't build a complete banking union. Yes. Some elements were not part of the architecture and have not been implemented. Now, why? If we go to the political economy, I would say, well, some people were afraid. Basically, a common European deposit scheme would mean risk sharing, while risks were still very diversified. On the single resolution, the same. Basically, only some banks would be subject to it, and so on and so forth. Now, 10 years have moved, and what do we learn? Well, first, on the risk sharing, risk reduction has been enormously reduced. Yeah. I would say provocatively, I don't want to talk about Italy, but the Spanish banking system is maybe more stable and sounder than the German one, if you can say. Yes. So it should be the Spanish depositors who should be afraid of. So risk has been reduced. The incentive or the disincentive to create a common insurance scheme, I think, should rationally be examined, and we should move forward to really build something that is more durable. On the resolution system, we have seen a resolution in other parts of the world. We have seen what we are missing, the link between the central bank, the single resolution fund, maybe also, how would I say, this fixation about taxpayers never having to pay, which ultimately puts a risk on taxpayer. So I think we can learn from the last 10 years to move forward, to have a bit of courage, to stop distrusting each other, to move a step further. This, I think, would help build a stronger banking union.
Thank you. Now, coming back to the capital market union, so lots of ink has been spilled on the need for capital market union, but also on specific policy reforms to move forward, but we've seen little effect. In your view, what is the single most important stumbling block for that?
I think that, like any move towards more Europe, there are distributional effects. Now, some of these distributional effects are due to, I would say, superstructure, or I don't want to use Marxist terms, but bureaucratic. I mean, moving responsibility of supervision from the national to the European. Yeah. Now, clearly, this is being opposed by those who lose powers, as the Americans say. Turkeys don't vote for Christmas. But okay, this maybe is not a relevant issue for macro terms. There may be some more serious distributional effects that we have to take into account. I think we are living in Europe in the illusion that status quo can persist over the next 10 or 20 years. So some would say, well, if I move to a capital market union, what is it in for me, for my country, for my stock exchange, for my institutions, which may be losing in the competition? No? The problem is that with the next 10 years, things are going to change dramatically, because we are in a global competitive environment, and to name things as they are, Wall Street is gaining out of the fragmentation in Europe. American institutions at all levels are gaining from the fragmentation because they are based on a strong, large, liquid capital market. So if we think that the status quo is going to continue, we are creating an illusion for ourselves. In fact, a no change is in fact means more fragmentation, smaller institutions, and ultimately many companies moving to outside to be listed, for instance, outside Europe to Wall Street, financial institution, asset managers, so forth, shrinking and shrinking, and therefore basically the savings of Europe being managed by outside Europe, or at least with a framework, a financial framework, which is not necessarily in the interest of Europe. Just to mention, for instance, in terms of safe asset, in terms of home bias, I mean, all the things that we learn in finance are clearly not managed, I think, in the interest of European companies, and therefore European companies will move, and therefore the real economy will ultimately, the real European growth, investments, I think will suffer.
Yeah. So by standing still, we would be losing out. So we have to move ahead. That's the
yes. I mean, it would be an illusion to say, you know, I have my little financial market, one of the 27. It's not that bad. Maybe I would be losing if we move to one. But this is an illusion to think that the status quo will persist. And that's what we observe in the in most national markets. They are shrinking. Financial institutions are shrinking, and the companies, European companies that need to invest, will go and look outside Europe, and that's not in the interest of Europe in the end.
Now, given that everybody talks about the capital market union, including there's this French-German statement, are you optimistic for the next 5 years that we can actually achieve something in this area?
Well, I think we need to be optimistic, although typically Europe moves forward through crisis, and you don't want to wish for a crisis to move forward. So what you may wish for is that the new Commission will try to exercise some leadership, will try to explain things. I mean, not to hide those that are the real and unreal opposition to capital market union, the standing blocks, and trying to find compromises and political, as has happened in the past in other areas like the banking union, not wait for a crisis and maintain the leadership, not give up. I mean, some of the initiatives after the financial crisis, like securitization, were stopped because people thought that securitization would bring back the CLOs, CLO squares, all the speculative hysteria of the past, but this is not necessarily the case. You can regulate well and have good securitization, which helps companies, which helps households, financial institutions, and everybody. So if you regulate well, if you do things well, you can move forward in the interest of everybody. So, but you need some leadership, and I hope the new Commission will lead.
Thank you very much, Lorenzo,
Thank you.
for your time.
Thank you.